Hello and welcome to Talking Automotive with Mark and John. My name's Mark Palavestra and my co-host, John Sinclair.
Hi, Mark. Good to speak to you again.
Well, today, John, we've got a very good guest and experienced guest today. We've got you, and we're going to be asking you about the dealer network, the distribution model, and the very topical one of dealer agency and agency distribution, the complexities of EVs and autonomous cars, and some of the alternatives to the current state of moving vehicles in and out of the country through either a dealer network or some other model.
Yeah, Mark, it's definitely a real changing environment. So it makes a fascinating discussion, and I think it's going to continue to change. So something dealers need to be across. Let's jump into it.
With 30 years' experience in auto logistics and state-of-the-art locations in 5 major Australian cities, Precar Fleet Services is an independent division of Precar Services, offering specialty fleet fit-outs for commercial applications ranging from simple tray and tow bar fitments to fully bespoke service body and accessory installation. With quality-assured safety, compliance and standardisation of vehicle builds, Precar Fleet Services are a premier all-in-one solutions provider for commercial vehicle fleet operators, leasing companies, and original equipment manufacturers. For further information on how Precar Fleet Services can assist in solving your commercial vehicle fit-out needs, please visit precar.com.au and click on the link to Fleet Services.
Today, we're going to discuss the dealer distribution model, the current state, and the future state. There's been a lot of talk about agency, but I think it's important for us to revisit what the current process and model is of getting vehicles into the country and to retail customers and how it's transacted. So today, John Sinclair and I will deep dive where it's at and where it's going.
Yeah, thanks very much, Mark. I think there's going to be an interesting discussion because you're starting to get different models of how to distribute products coming into the market. And that's going to change the whole way dealers approach things and what they need to do in the future from an investment cost point of view, and then how they distribute those products. So it's an interesting discussion. So let's jump into it.
CarsApp is a digital platform across both web and app clients that helps sellers of motor vehicle assets to reach and transact with a larger audience in the B2B space. CarsApp allows you to seamlessly and efficiently list your wholesale inventory either by DMS integration or manual entry, and then transact either via a tender format or in the marketplace. Why let your wholesale inventory only be made available to a limited number of buyers when you can tap into an engaged buyer marketplace on CarsApp with a national reach of over 800 plus registered users? Increase your audience and improve your returns on your wholesale stock. Connect with CarsApp via LinkedIn or on the web at carsapp.com.au or reach out directly to Andrew Tyson at andrew.tyson@carsapp.com.au. So, John, we talked about the dealer distribution model, the franchise distribution model. Been around for a long time. Henry Ford was one of the pioneers in the industry, not only just in manufacturing, but also in getting vehicles to independent businesses across the US. And then he took that model over to Europe to expand the franchise business and also sell more vehicles. Tell us more about how it works and why did he do it? And what are the benefits to the manufacturer and the benefits to the dealer?
Well, I think the important thing about the way Henry Ford worked is he needed to have a very efficient factory. To get that efficiency, he needed to produce so many vehicles a day and make sure they're constantly coming out of the factory. And the best way to do that is he needed to get them sold as quickly as possible. And that's sort of how the franchise model developed. So the vehicles produced in the factory comes out, he immediately sells that to someone who's going to on-sell the product. They pay for the vehicle, and then they take the responsibility to then sell that to the customer, which could take a month or 2 months or 3 months. But his important thing was to make sure as it's produced, it's sold, and he's paid the money, and he can bring in the next vehicle and start producing that. The amount of capital outlay invested is running at the most efficient level. So in terms of the current franchise model that's still in existence right across many countries today, and the way most automotive manufacturers work, is they will produce the vehicle, It will come out to the factory. A dealer will purchase that vehicle, and he will then pay for the vehicle before it leaves the premises of the manufacturer or distributor. If the vehicle's been shipped to another market or overseas, that vehicle will be shipped by ship. But once it lands in the country, a dealer will then have to pay for it before it leaves the distribution center. And then in some instances, the distributor or the manufacturer may support the dealer in paying some sort of interest for a certain interest-free period. That might be 30 days, it might be 45 days, it could be 60 days, depending on the type of product and how long they think it should take the dealer to sell. Most dealers will sell a vehicle within probably 50 to 55 days. That's how quick they want to turn over their stock. If they can get it around the 50 days, they're running quite an efficient business model. That gives them enough time to get the vehicle there, do the pre-delivery service, get it cleaned up, get it on display, and then market the vehicle to customers.
So it's interesting that point that you raised there, because this is now coming into play for the Australian market right now, where nothing's made here. As you say, vehicles are invoiced before they leave the gate. They're invoiced as they leave the gate. So the manufacturer gets the money as the car leaves the compound. If you're manufacturing Europe, your cash flow immediately occurs once you put it on a truck and send it to the dealership in Germany or in France or in Sweden. Putting it on a boat and getting it here, the factory doesn't get its cash for potentially 2 months. And this is where there's the delays in free cash flow for vehicle OEMs, whereby they prefer to look after their local markets where they get their cash quickly. And a lot of the times there are OEMs that won't supply distant markets when it comes to end of financial period reporting. So it's a very interesting point that you raised there, that it is very much a immediate cash flow process. Leaving gate, it's paid for. So the manufacturer's got their money, they can pay all their workers, they can pay all their suppliers and continue to build vehicles and keep the sausage machine going. Now, when you talk about the network, the distribution bit, and you're looking at a brand in Australia who's either setting up or has dealers, what is the strategy to have dealers as far as the footprint? Because we always hear about this term network footprint. How or what determines where you put a dealer from a location perspective?
So the first thing, Mark, when you come in and approach a market, the first thing you'll do is set up a geomarketing study. So that would look at where the population is located, income statuses, and it will look at a whole range of factors around people's ability to buy cars. It will also look at current history in terms of how many vehicles are being sold per postcode. It will look at trends of populations growing in certain areas or decreasing. So that's the first step, is seeing where the population is. A second overlay you might do on that is looking at your competitors and where are all their dealerships located, because you base on the assumption that they've also done these studies in the past. So that will cross-reference and be a check to you. If you see it, 5 or 6 of your main competitors all have dealerships in the area and your study is showing you don't need a dealership there, you may need to go back and relook at that point and say, have I missed something? You also have to be quite careful about some of these studies, because you may often get vehicles registered in a certain postal code because the head office is situated there. So it might be a rental company or it might be FMO located in a certain area. So these skew the figures. So you might think, there's a big opportunity there, but it's not. It's just a head office registering a lot of vehicles there, but those vehicles might be distributed around the country. So you start to take those things into account. The second part of that is then you start to look at travel times. On average, a person will travel about 35 minutes to buy a car, and he'll travel between 15 and 20 minutes to service a vehicle. So you then start to overlay your population, and then you ring fence how far those people will travel. Now that's different for rural areas or in metro areas, because in a rural area they might travel further because they're used to traveling and they're prepared to travel an hour to get a car serviced or to buy a car. But it also depends on the type of brand you're trying to sell. So if you like a very exclusive premium type car, like a Porsche or a Maserati, where someone might be prepared to travel right across Melbourne. So they might be able to travel an hour to buy their car or service their car. But if you've got a volume car, the chance that customer is going to travel past 6 or 8 of your competitors to come to service with you or buy from you when you're very unknown brand or not a strong brand, it's the chance of that happening is very minimal. So once you have those sort of figures, you then can get a viability of the area and start to see what sort of volume a dealer would need to make in terms of the required investment to set up a dealership. Because once a dealership sets up, he needs to put in signage, he needs to employ sales staff, he needs to train them, he needs to buy special tools, he needs to carry parts inventory to service the vehicle, he needs to train technicians. So there's a lot of investment and cost. So if you set up a dealer that's not going to be viable, or you can't justify the business proposition to that dealer, it's not going to work. And in 6 months or a year's time or 2 years' time, you're going to have a very unhappy dealer because he's losing money. Another factor to look at is travel routes, because a customer, he may driving in towards the city going to work, he might stop off and service his vehicle or drop his car off for a service. But it's very seldom that he'll drive away from the city if his main route to work is towards the city to get it serviced, because it's just mentally customers can't get around that you want to drive away from the city. So there are companies that specialize in this type of geomapping. They actually map, and you can see the customer areas. And once you got that, you then define how many vehicles are currently being sold in that area. And if you're a new brand and you think you can get 1% market share, you can start to get pretty accurate volumes of how much you're going to sell. Often when speaking to new dealers, some of the dealers, because they feel that they're the only dealer in Melbourne, they could sell all the vehicles. When you base it on figures and come down to reality, it might happen on rare occasion if you're discounting aggressively on the internet, and it's such a good offer that the customer will come across. But in normal volume selling, you need to run the figures properly and have a good idea of what you're going to do. And
what would be some of the throughput metrics that you'd be looking for a sustainable business model? Is it how many sales per sales consultant? What are the metrics that matter when you're looking at the viability of a dealership?
The first thing is, how many sales do you think you could get for the dealership? And you need to be quite realistic about it, because often you get manufacturers coming in, and if you added up all the market share manufacturers want to achieve, it's like 200% of the market. And I think that causes a lot of distress in your distribution channel, causes distress with dealers, means you're bringing in too much stock. The more accurate you can get the figures, and the better the planning you do, you have to be realistic about what you can achieve. And the more accurate you get that, better the relationship between the distributor and the dealer, and the distributor and the factory. What often happens is in some of the markets, especially a smaller market like Australia, you'll get someone come out and they will just say, I'm sure you can sell double that amount. And that's when the stress starts, because then you start ordering that stock for that amount, but the market isn't really ready to take that sort of volume. So then you start forcing stock on dealers. Dealers start having to try and discount because they need to keep moving the stock. And then all types of issues, come in. So planning is probably one of the key metrics. And it's not about gut feel. It's about the figures and what the figures tell you.
Now, you talk about the numbers there. Now, what about facility? So you've got the location sorted. So you pick a location that is in an auto precinct, fairly middle-class suburb, mainstream. We know that 50-year-olds is the average new car buyer. So you've got all that demographic data overlaid. So there's the current market data for your competitors. You may have some competitors in that precinct. So you select the location. What's the requirement from a facility perspective?
Location is really important, and it's quite often good to be located where most of your competitors are located, because if someone's coming in the market to look for a car, if you in that automotive precinct, people will see you. And before you even look at facility, you need to look at the businesses that are there and the financial strength of those businesses, how long they've been in the market. Because someone who's been in the market selling vehicles for 30, 40 years, he has very strong contacts with fleets. He has very strong customer base. He has a lot of people coming in and servicing cars already with him. It's a lot easier for him to, sell your product than someone starting from fresh and still having to prove themselves. So once you get that all sorted out, you then start looking at facilities. Do you have place to display vehicles? Do you have sufficient service bays? What is the workshop capacity? How many vehicles are being serviced a day? You have to start doing capacity reviews of the service workshop. You need to look at how many cars they need to sell. If you see the potential of selling so many cars, you then have to see, he then needs place for customers to park. They need places to park demonstrators. Every time they sell a car, they might be taking a used car, depending on their used car to new car ratio. Where they're going to display those used cars? Do they have storage area for cars on site, or do they have other storage areas? So there's a lot of factors you start looking into. The challenge you have as a very small brand is not many people want to take on your brand. And you basically, I always say you're groveling in front of prospective dealers and trying to entice them to take your brand. And you sometimes have to just take whoever you can get. But if you have a strong brand, you might have 3 or 4 or 5 potential candidates wanting to take your brand. And then you can set up a proper assessment of these are the potential candidates, and you have each of the column and you rate them in all the particular areas, and then you'll present that to your management team and then take a view on, who the best candidate is. Another important factor that people don't often look at is succession planning and retention of staff, the strength of staff in the dealership, staff turnover. Those often are underlying factors that people don't look at, but they tell you a lot about the business and what's happening in that business. Because sometimes you might have someone who's in their mid-60s that will come up for retirement quite soon, but he has no succession plan. And that you could appoint him as a dealer, but in 2-3 years' time, you're not sure what's going to happen or who's going to take over, what's going to be the impact on that business. Will the people who take over have financial capacity or strength to continue to run the business? So those are all factors you need to look at just to understand what's happening in the business.
So there's the facility side, which you mentioned is quite important, but the personnel side, the people. So the leadership, the turnover. So we know from the data that when you look at CSI results in the dealership, high staff turnover equals low CSI equals low gross profit, because you've got these constant newbies coming in, being trained. They're not confident because they're fearful that they'll be discharged at any moment. So they're not a confident team player in the dealership. And that's where you get this churn, which then means the customer experience is bad. And one thing our mentor, Paul Fisher, has taught us that if you don't look after your customers, they'll put you out of business. And there's that trend. So it's interesting that that's a significant part of a network distribution strategy in the current state.
Another important part is the management team. If you see the management team has been there for 10, 15, 20 years, it normally means the staff underneath him have also been there for a long time. If the management team is churning over, you normally find there'll be staff churn below them. And a lot of the successful businesses, you'll go in, and that's the first thing you'll see. Very strong management team, been around a long time. They know the business inside out. They know how to make money. Bringing new people in all the time, it makes it really tough to make money, because the automotive market is a tough business. The difference between a dealer losing money and making money is very small. It's 2-3%. So it doesn't take much to go from making money or losing money. And the successful businesses are the ones who've been there a long time. They have to eke out existence. They really work the business hard, and they get the profitability.
Now, we mentioned standards. So how important are standards when it comes to managing the dealer network, and what are the standards that matter?
The standards are extremely important, but it's not just visual standards. Visual standards are important in terms of the respect that the first impression people have of your brand. So people will be looking online, they then want to come and test drive a car. If they come into the dealership, there's no signage. Firstly, they won't be assigned it, they don't know about it. It's actually quite interesting. Dealers whose facilities look better, they actually get better margin on their cars, because people psychologically agree to pay more. But when the place is looking shabby or it doesn't look like a proper dealership, people expect a bigger discount. We've seen that across countries in Europe and South Africa, and I think you'll probably get the same type of thing here. The other part of visual identity standard is a person's driving past the dealership every day. So they see the facilities. And then they see stuff on social media, they see advertising, they see a billboard. You touching them on a regular basis, and then they start to feel they sort of know you or you're part of the community. Then the standards around the training of the staff, so that all your sales staff are properly trained, the technicians are properly trained, you've got the right IT equipment, you've got all the special tools that you can do the correct servicing, you've got the right number of service bays, you've got the right fuels and oils and everything that needs to be used. So that's all part of standards, and it's very important to manage those standards. I think the important thing with standards is, and this is where it sometimes breaks down, is I think standards need to make good business sense, because if they make good business sense and can be justified to the dealer, dealers are happy to implement those standards. It's when a manufacturer comes with business standards that don't make business sense. You're selling 2 or 3 cars, but they want this massive showroom. That becomes where standards are a problem. It's very difficult for you as a distributor or OEM to stand up by those standards if they don't make any business sense. And I think often what you find is you have a tiered approach. So if you're selling only so many units, you have this level of standards. If you sell that many units, and so you step it up as dealers grow or as the brand grows or the volume grows.
So things like, John, the furniture, being the factory furniture in the showroom, the tile colours. What about the tiles? There's often a debate around if a dealer has a showroom, they've got white tiles, but they need to be grey tiles. They've got to rip all the tiles up. How's that get managed, and what's more important there?
That comes back to the business justification. It's sometimes very difficult to justify that a change in colour of tiles is going to make a major difference to the sales. I think you maybe need to say, okay, in your big high volume dealers in your major metropolitan areas, that you as a brand want to portray some sort of image, or if you're a very exclusive brand, you want to portray that image and you want a specific black tile with a certain spec. But then you need to come with some sort of business support to support the dealer. And you say, okay, I want you to put up the showroom, you put up the facility, and I'm going to support some of the tiles and some of the other things which I want specifically for my brand. So it can work, and it can work very well. But for some little small dealer in the countryside to demand him to have black tiles, or because it will become difficult if you're not doing the volume, you won't be able to support him to do those tiles, and he won't be able to do it. So I think it comes back to business sense.
Now, another question for you around standards. So we took that; they're the hard standards. There's the nuts, the bolts of the windows, the glass, the floor. Now, the soft skill standards, which many brands have balanced scorecards or variable margins in their reward structures around soft skill standards, which is how long it takes to respond to an email, dress standards of the sales consultants, name tags, the sales process standards as far as CSI results, other standards around showroom display, like having out-of-date posters taken down and having the up-to-date merchandise around on display, etc. What is best practice in that area?
Well, I think it's very important to have a professional-looking facility. What we have to remember, and this is where you have to step back a bit, if you go into a store in the city to buy a suit, you're buying a suit for a couple of $100, and when you go in, that display of that suit is impeccable. There's lighting, it's properly presented, everything's looking good. Now, we're trying to sell a car that's worth $40,000, $50,000, and we're saying, well, we're not going to present it properly. The more you do in that regard, and the better you present it, the more professional you are, people want to deal with successful businesses. So if you look like you're successful, people will come and buy from you. It works both ways. You need to do it. It's difficult that you have to try and enforce standards. I think it should be both ways, that dealers want to do the standards and it makes business sense and the manufacturers drive it. The difficulty is there's so many dealers offering selling 4 or 5 brands out of the same dealer facility. And that's when it becomes difficult, because you have a salesman probably selling 2 or 3 brands. And it's how do you get more equal time that your salesperson or your sales consultant has sufficient knowledge of your product? Because otherwise you risk that the customer comes in, because he's selling 5 or 6 of those a week compared to this brand where he only sells 1 a week, his product knowledge is probably better here, and you'll try and switch a customer to the product where he knows the product better.
And training. So we're talking about the soft skills now. Training's a big part of network development. What processes and skills do you need to be constantly updating in a franchise dealer network, from the OEM to the dealers?
Well, there's a whole range of training that you need. There's the brand attributes and the brand history. And so if a salesman doesn't understand the brand or where it comes from or where it's manufactured and those type of factors, it's very difficult for him to try and sell a vehicle, because there might be certain factors out of that he can emphasize, saying, no, well, the quality is really good because it comes from, it's manufactured in this country, and the reason is that country is such good manufacturing compared to maybe a different country. So there's a lot of things that can come from the brand and the brand history. It's more than just selling a metal. You're trying to sell the dream and what people aspire to. And then there's the selling skills and everything around how to sell, how to negotiate, how to present a car. So you have all those type of skills. You then, depending on if you have separate people doing the finance, there is certain certification in that you need to have, because not anyone can just go out and sell finance. And then you need the actual product and product specifications and the pricing, that people have a good knowledge of the vehicle. And if they speak about competitors, they can say, yes, that competitor is better in that aspect, but we are better in 3 or 4 other things. And that's why you should buy our product. The after-sale side, even on parts side, there's a parts interpreters who have to order parts and know the parts. There's the warranty clerks and the systems for claiming warranty. And then there's the service technicians. As a big brand, you would have very experienced technicians and then younger technicians coming up. You eventually replace the older, more experienced technicians as time goes by.
So it's a fairly complex beast, isn't it? The current state in the franchise dealer model. And the last piece is marketing done by the dealership. Because what I'm keen to ask, the next question after this, John, is this talk about going to agency. So right now, we're talking about a business model where the manufacturer wholesales the car to the dealer. The dealer is carrying that inventory, has to have all of those elements of facility, the location. So there's rent, there's maintenance on the facility, there's investment in the facility, there's investment in their people and personnel and training, and also their financial acumen has to be right up there, because they've got a very marginal business case where, as you said, it's 2% net profit to sales, probably a little bit higher at the moment, but it can be as low as 1% or negative. So there isn't a lot of margin for error if you get a major hiccup like a COVID-19 shutdown. So the last one is marketing. And once we cover this, I'm keen to then go to the next phase, which is how is it different in the new proposed and what the future state looks like with agency and also with the introduction of EVs. But before we get to that, marketing for the current state for the dealers. What's the collaboration like with the OEM and the dealer remarketing?
Well, to me, I think there's 2 levels of marketing. There's marketing the brand at a national level, and I think that should be always the responsibility of the OEM. The dealer, I think what's really important for him is to market his brand. So if you're in this area and you want to buy these brands, you need to come to this, whoever that dealer is. And you need to take responsibility for marketing in your area. More the hard retail type marketing. You want to do a deal, come to me and I'll give you this type of deal. We're running a special on these vehicles. We're doing this type of program. So he does the marketing that to get customers in that will come and buy the vehicle right now. And it's very important that they drive that really hard, because they need to, if they've been in that community a long time and they're very well known, that's good for them.
As far as online, conforming with the OEM, is there often friction between the dealers and the OEM as to how the brand is being represented, and often is there pain points with standards that?
It's very difficult from a distributor to restrict a dealer in how he sells online or what pricing he uses. My sort of feel and my recommendation is always not to try and sell your vehicles across town or across the state or in other states and that. I think the important thing is to understand where your prime marketing area and focus on that. If you can get that right, I think that's the best way to create success, because then people are coming to buy from you because you give the best service in the area. And they know if something happens to their vehicle or they break down, you will support them to send out someone to tow the vehicle or send out a technician to check what's happened or whatever. So you provide that personal service, and people know that if they come to you, you might charge them a bit more. You're not going to give them this huge discount, but you're going to give them really good service, and they can rely on you and trust you, and because you're going to meet them in the local pub, and you're going to meet them down at the footy ground, and you're going to meet them at the sports field watching your kids play sport, and they get to know you and trust you. The issue comes in on online marketing is where dealers start to discount online, and then they think, well, I'm selling more cars, but you get into this whole treadmill of just lowering prices, and when you give away your margin, you start to put huge pressure on your business because you don't cost everything properly. And if you've got a $50,000 car and you give $1,000 away, that could be 80% of your profit if you're only making $1,600 per car. And this is where they get it wrong. They don't realize how much profit they're giving away and how easy it is to give it away. And if you start going online and start doing all those things, if you just focus on your own area, do it properly, I think you have a better chance of getting more profitable deals.
But other things with online, what if it was a premium brand and the dealer wants to put a pink elephant with flashing lights in the ad just to attract attention, or have a inflatable gorilla on top of their showroom? How does that fit with brand standards?
Well, I think that there's always an issue with that because that is not the right type of image you want to portray as a brand. And that comes back to your national brand. And that's why it's very important for the brand to make sure that it enforces those standards of what the image is and what the perception is of your brand. It's easy to destroy a brand. You can destroy it very quickly. So it's important to have proper structure around that and look professional in how you portray it.
Okay. Now we'll look at the future state. That's the current state of play. So all those forces are pulling and pushing where and how an OEM distributes cars through the current dealer network. So all those issues around standards and trying to control and having a consistent message across every site, given that every site is owned by an independent business person. The benefits for the OEM, they get their money straight away. The challenges for the OEM is you're getting different interpretations, if you like, of that distribution process. And the nirvana for the OEM is that it's the same car delivered in the same way, at the same transactional price and the same customer experience to a standard that the brand wants to portray and have the optimum in customer satisfaction across the board, across the country, through all of these different sites. So this is where there's now a lot of chat around agency. So how does agency differ from the current state, John?
So agency is slightly different. What normally would happen is the vehicle is paid for when it leaves the gate. Whereas in terms of the agency model, the vehicle is sent to the dealer, but it still remains the stock of the distributor or the sales company. And they might have certain clauses in that after 60 days or at some sort of period, it might then become the stock of the dealer. Demonstrators in that might be registered, and then the dealer pays for that, and then it becomes the dealer stock. But what it means is the OEM or distributor, he will set the price for the vehicle. You can't go in and negotiate price. If you go into a dealer, that's a set price. And the dealer from that gets a set commission. There's still ability to negotiate on the used car, and that will always be because sometimes there's a used car involved in the deal, sometimes there's not. So there might be opportunity to trade on that. The challenge with the agency model is in terms of you have a factory churning out certain number of units and to make it viable and efficient. With the agency model, it's going to become a lot harder for the distributors in that to push stock and to drive sales, because once the dealer's got it, he's going to move it. And as a distribution company or marketing company, you're going to rely on the dealers move that stock for you. They're not going to have the same ability to force stock through the system. So I know some of the manufacturers said they will look at what a natural volume is and let their volume come down to that and just focus on that amount. But when you've got a factory that has to deliver so many thousand units a year to be viable, and if the volume is dropping, they're going to get concerned about it. And that's where the forces are going to come through, is how do you drive that stock. So I think you're going to see agency models coming, and it's going to make quite a big difference. I think you'll see, as a result of it, dealer profitability will improve because there's less ability to trade against each other. They don't need to hold the cost of the vehicle, so that will help their profitability go up. But I think you will see the volumes come down a bit for some of the manufacturers.
So it's interesting. So why would the manufacturers want to go down this road if there's more risk now in the manufacturer, they don't get their cash flow like they currently get now, and if there is a hiccup in the retail side, the manufacturer wears that it has to fund that inventory for a lot longer?
Well, I think a big part of it, I think they'll see it as more profitable for themselves. They might be able to get more margin out of the whole deal, and because they got more control over the pipeline and the process of the sale. So they might make some more money on that. So I think that's one objective. It also allows them to then become more aggressive selling online and doing other sales activities themselves, and then just letting the dealer, deliver the product for them, getting that same sort of level of margin. So it does open up that side of it. So it's going to be interesting to see what happens. We've seen some of this already happening in South Africa, and I think maybe on a future podcast we could interview some of the guys there to just see what has been the impact and what has been the implications of moving to an agency model. But I think what's happening is the whole market is in turmoil, and there's going to be some significant changes. So it's very important for dealers to start having a really good look at what their cost structures are and how they're operating to make sure they can adapt and change to the changing environment.
Now, the other question, the next one, is that this decade that's coming is going to be a significant decade of change, as flagged by Mike Sinclair when he talked about the obligation of the media to inform customers and motoring purchasers about the new evolutions. So you've got agency coming, you've got subscription, and you've got EVs and autonomous cars in the longer term. How does the EV in the medium term, if you like, it sounds funny talking about EVs in the short to medium term, how does that fit in with the agency model?
To me, I think it's a big threat to the whole distribution channel, whether it's agency model or traditional franchise model. This is going to force a really big, significant change. And when we spoke to Christoph Depana, and that was when it really struck me, when he said that 70% of EV batteries are made in China, and there's 60 new EV brands coming out of China. And you're already starting to read about deals being done with some of these brands, with some of the traditional manufacturers. Now, the thing is, if the battery for a whole range of brands is the similar battery coming out of the same factory, there's no differentiation between the product. And basically, adding a steering mechanism adding a body and 4 wheels is going to make the vehicle more commodity. Once that comes in, these EV companies are going to be the same as Tesla. They're going to come in, they're going to set up maybe one sales office and 3 or 4 distribution centers in each city, and they're going to get some aftermarket service provider to provide the servicing for those cars, because there's going to be less servicing and the way you do servicing will change. So this allows that all to happen. And with that happening, because they want to come into the market, they can drive down price and margin. So you're not going to have this margin that's going to allow for a dealer network or holding cars for 60 days or all the traditional things were provided for in the previous franchise distribution model. Signage and standards and that all costs money and has to be provided for in the margin. There's not going to be that space anymore. So I think this is going to be a major disruption. I think dealers, they need to really start looking at how they're operating, where their facilities are located. Can they move servicing facilities into lower top cost areas? Can they do their deliveries from different areas? Where do they do their used cars from? Scope down the size of their showrooms and that. So really look at their cost structures, because if they don't, it's going to have major impact on them going forward. And I think some of the dealers, there's some dealers at the moment going through a lot of heartache as Honda have changed their business distribution model. But I think there's going to be more of that going forward. And I think it's probably would be good for most dealers now to really look at how can they diversify those businesses? Can they start doing some of that aftermarket business? Do they get in accessory type businesses where they fit and sell accessories in that? So they're not reliant on the traditional franchise vehicle sales model. They need to diversify into a range of things and look at how they manage that profitability and the change going forward.
So if I was to summarize what you just covered, because you've covered a fair bit there, the current state is not likely to remain in its entirety. So potentially we'll have a hybrid of some brands staying with the current state and other brands going down the road with the future state. And the future state is agency, and then potentially newer brands coming in that even leapfrog agency and go to a direct sales model. So there's actually 3 different variations, if you like, from a distribution network perspective. And it's got different implications for A, the dealers, B, the OEMs, but ultimately the customer should have the seamless approach. So really the net effect for the customer is you can still buy a vehicle, you can still service the vehicle, and you can still sell the vehicle again. So this is where there's the aftermarket. That's a critical piece in the ecosystem. And this is where, when you look at some of the podcasts that we've done in the past with Stewart Charity and the aftermarket, that's an integral player in this whole system. Given there's 19 billion cars on the road, 1 million new ones coming in, but how the new ones come in and get service for their first 5 years may be different to what the current state is. Some will stay with dealers, some will go to these other different models. So interesting times. And with the new technologies, call for different distribution models. The current state's been very robust. It's been with us for over 120 years. So when Henry Ford first set it up, it's worked well, and it potentially will still work well for some brands. But others are looking for that edge, and it's how can you get those efficiencies. But you highlighted facilities important, and the importance to have standards that match what the brand is all about. So if the brand's portraying a premium, the facilities need to match that. If the brand is mainstream, it still needs to have a good, clean, and acceptable experience that fits in with the brand. How the dealer markets the business needs to fit in with the brand. If you are a premium, you don't want to have inflatable gorillas on the roof. You don't want to have pink elephants on your ads, and you need to be telling a consistent story. You don't want to be sort of old school snake oil salesman type process. You want to be a very professional operation. And that's where the people come into play. You don't want to be churning staff because you're going to keep retraining them. And this is where good management, and you're looking at the structures where there's been good staff retention and good financial stewardship in a dealership, flags a good dealer, because that means it's someone you can do business with in the long term. You don't want to be doing business with someone today and they're gone tomorrow. So all of those elements are very important, whether it be current and future state. When you look at it, those standards are still very much in play across the 3 different models that you talk of. And throughputs. It really comes down to, it has to make sense to be in the business. Because if it doesn't make sense and the numbers don't add up, then there's no point. There's no sustainable business model. And ultimately, the customer loses out. Because if the customer needs a facility to go back to for service and trade in their vehicle or buy another vehicle, they want to buy from someone that they trust, that they know. It gives them a better experience. So the viability, the numbers, and you talked about the study. The study can be misleading if you look at a market that shows huge volumes, but it may be overinflated by a fleet or a government agency buying volumes through there. So it's very much a people business, but there are lots of changes coming. So hopefully our audience enjoyed the discussion today. We've had a lot of questions around this, so hopefully we've addressed many of those questions. If you have any further questions about what you've heard today, please reach out to either John Sinclair or myself, Mark Palavestra, on LinkedIn. Please subscribe to the channel below and leave a comment. We're definitely keen to get back to you if you need more detail or if you have any views around what is a very controversial topic. And thank you, John, for sharing your insights.
Yeah, thanks, Mark. We look forward to speaking to you again next week. Thank you very much.